Very good morning to everyone and welcome to a session on transfer pricing in GST. I believe many of you must be attending the seminars on goods and service tax or might be busy in deciding the policies or implementing the goods and service tax law which would going to be applicable after 1st April 2007. But very important provision in GST model law, and which would certainly going to come in the final regulations, is the transfer pricing. We have already seen that when transfer pricing law was introduced in the Income Tax Act in 2001, it created a lot of trouble or hardship for taxpayers, because of which a lot of additions happened in the income tax, in the transfer pricing assessment that took place. Now the same law or the same provision in a bit different manner, or I will say with the same thinking that the transaction should be at arm's length, is going to come in a modified way under the GST law. So in today's session we are going to understand in brief what are the provisions relating to transfer pricing in GST model law. To take help, in front of me we have got slides which broadly captures the law or the provisions given in the GST. So we will read this and we will try to explain what it says. And do keep in mind, while deriving your pricing policy for GST law, while implementing, do not forget to take care of transfer pricing, because it can actually erode your profitability. So we have chapter 4 under model GST law, which talks about value of taxable supply, that how the value of taxable supply should be determined, or what should be the value of the taxable supply. So this subsection 1 or section 1 of chapter 15 says, the value of supply of goods and services shall be the transaction value, that is the price actually paid or payable for the said supply of goods or services, where the supplier and the recipient of supply are not related, and the price is the sole consideration for the supply. When it says in normal circumstances, when you are not dealing with a related party, the transaction value can be considered as the final price if it is only the sole consideration for this transaction. But when you are dealing with your related party, in that case transaction value cannot be considered as the final value to determine the taxes. So from subsection 1 we go to subsection 4, which talks about if there is a related party transactions, then you will follow the rule 3 of valuation rules. And if we go to rule 3, or it says the transaction value shall be accepted even where the supplier and recipient of supply are related, provided that relationship has not influenced the price. So under subclause 1, it says if there is a transaction which does not have impact on the prices, if there is a transaction between two related parties, in such a case you cannot take transaction value as the final price. And when we go to the valuation rule, it says the same thing. And then we have rules, or we have method, it prescribes the method which one needs to adopt in case there is a related party transactions to compute the arm's length price, or to justify what should be the transaction value. But before we will understand that what are the methods available to us to compute the value, transaction value, if there is a transaction with the related party. Let's understand. So there is a section 2 subsection 82 which gives or defines who all are the related persons. So the first point says, person shall be deemed to be related person if only they are officers or directors of one another's business. So for example, let's say there is Mr. A and Mr. B. Mr. A is a director in B's business and Mr. B is officer in Mr. A's business, then both A and B would be regarded as related parties. One more thing, the word persons cover the legal person. So when they say person, it does not only mean the individuals, it also includes your corporates or companies or partnership firms which are legal persons. Second type of relationship that it covers is they are legally recognized partners in business. So let's say there is one business, there is one joint venture, and both Mr. A and Mr. B decided to become a partner in that joint venture. And both are partners. Now Mr. A and Mr. B would be regarded as a related party for the purpose of GST law. So if there is any transaction between Mr. A and Mr. B, it will get covered. From a corporate perspective, let's say there are two companies, company ABC and company XYZ. They decided to start a joint venture wherein ABC only owns, let's say, 10% and 90% is owned by XYZ. So being both are now partner in the JV, any transaction between ABC and XYZ, and I'm not talking about the JV right now, I'm saying being their partner in the JV, the transaction between ABC and XYZ will also get covered under the provisions of related party transactions. Third point, they are employer and employees. It's very simple. If there is a transaction between employer and employee, it will get covered. So if a company sells goods to employees, it will get covered within the GST framework as related party transactions. Fourth, any person directly or indirectly owns, control or holds 5% or more of the outstanding voting stocks or shares of both of them. And I think it's one when you become a JV partner, and this one wherein the threshold set is very low. Just because you are owning 5% in another company, it would be deemed that you are a related party. So any transaction between a company and a holder or a shareholder who owns 5% or more would be regarded as a related party transactions, and it requires justification. So if I go to Income Tax Act, it talks about 20% in case of international transaction and 20% in case of domestic transaction. But when we come to GST law, the threshold is even less. It is only 5%. Next point which it covers is one of them directly or indirectly controls the others. So if there is a control of one entity over the other entity, irrespective of the holding, both would be regarded as related parties. Next relationship that it covers is both of them are directly or indirectly controlled by a third person. So let's say there is Mr. A. Mr. A is controlling company B and company C. Both company B and company C are independent entities. Now Mr. A is controlling company B and company C. So both company B and C would be regarded as related parties because of the common feature. And the last relationship it covers, that is section 2 subsection 82, that they are members of the same family. So if they are members of the same family, it will get covered within the definition of related party. So the definition given under section 2 subsection 82 is different from the Income Tax Act given in section 92 and 48(2)(b), and overall gamut under the taxes goes up. So either you will become a related party under the Income Tax Act or under the GST law, and it could also happen that you are related party both under the Income Tax Act and under the GST law. Interestingly, the objective under the how this Income Tax Act and GST law, or the officers are going to sit together, going to see it combinedly is very important, because otherwise it may create a trouble for taxpayers. Another important relationship it covers, which is given in explanation 2 to section 282, it says persons who are associated in the business of one another in that one is sole agent or sole distributor or sole concessionaire. So if you have appointed a sole agent, that sole agent would be regarded as a related party, and being it is a related party, you need to justify the prices. Now we have seen what all relationships are covered within the definition of section 282, that is related party. Now let's talk about the methods. What are the methods available to us for the purpose of justification? The transaction is not influenced by the relationship. So unlike Income Tax Act, which gives the 5 methods and which does not talk about any hierarchy, which talks about one needs to apply the most appropriate method, we find in GST law that there is a specific hierarchy, that one needs to follow that hierarchy. So in income tax we do not have any hierarchy, we need to follow the most appropriate method, whereas under the GST law we have hierarchy and we need to follow that hierarchy. And we have only 3 methods in the GST law, whereas we have 6 methods in the Income Tax Act. So under Income Tax Act we have comparable uncontrolled price method, we have resale price method, we have cost plus method, we have profit split method, we have transactional net margin method, and then we have a residual method, which is rule 10AB, any other method. However, when it comes to the GST, we have only 2 specific methods, and one is the residual method. So first method is determination of value of supply by comparison, which is something similar to CUP. Second is computed value method, which is something similar to cost plus method or TNM. And then we have a residual method. So if we are not able to follow any of the 2 methods, we need to go to the residual method. And interestingly, the first method which comes is CUP, that is the determination of value of supply by comparison. If we are not able to do the computation under rule 4, which is the determination of value of supply by comparison, then we will go to rule 5, with the method which is similar to cost plus method or a TNMM. And then if you are not able to compute value under rule 5 also, we will go to rule 6, which is a residual method. So let's discuss rule 4 first. So if you have a related party transaction, under rule 4 what you need to do? The name of rule 4 is determination of value of supply by comparison. So you need to find a comparable transaction. Comparable transaction with unrelated party of same or similar goods. If you have sold the same product to another customer under similar circumstances, that price can be considered as the price for the purpose of determination of value under the GST. And what the law says, let me read it for you. It says where the value of supply cannot be determined under rule 3, the value shall be determined on the basis of transaction value of goods or services of like kind and quality supplied at or about same time to other customers, adjusted in accordance with the provision of sub rule 2. So very specifically it says that what you need to compare is the same. So sub rule 2 of rule 4 gives few differences which needs to be adjusted. One is the difference in date of supply, if there is a difference in date of supply. Second is if there is a difference in commercial levels and quantity level. So you might have sold goods to a distributor and other goods to a consumer. And let's say final consumer is your related party. So can you take the price which you have sold it to the distributor? I think not, because there is a difference in the commercial level. So probably one needs to carry out the adjustment, or there is a quantity level difference. So to one customer you are selling 100 units. To a related party you are only selling 10 units. So if there is a impact of quantity on the prices, the rule allows you to do the adjustment. Then we say difference in composition, quality and design between the goods services being valued and the goods or services which they are compared. And if you believe that there is a difference in the composition, quality and design, then a proper adjustment should be carried out between the comparable transaction and between the transaction that is being compared. And then there is a difference in freight and insurance charges depending on the place of supply. So broadly, it talks about you need to find out the comparable transaction. That comparable transaction can be internal comparable transaction, that is you are supplying, you are selling it to customers, which are your related party and unrelated party, and then you are comparing. Or it also gives you an option that if there is no internal transaction, you can also go for an external transaction and find out the comparable price in the open market. But if you are not able to determine the value as per Rule 4, then you need to move on to Rule 5, which is computed value method. So we will not do, or we will not find any comparable transaction at the price level. What we need to do, let's see. Computed value method is similar to our cost plus method or a transactional net margin method under the income tax law. It says if the value cannot be determined under Rule 4, it shall be based on computed value, which shall include the following. So what all we need to include under the computed value method, let's see. First, the cost of production, manufacturing or processing of goods, or the cost of provision of services. Charges, if any, for the design or brand. And third, an amount towards profit and general expenses equal to that usually reflected in the supply of goods or services of the same class or kind as the goods or services being valued which are made by other supplier. So let's hold here. Let's try to understand what it says. It says first you will take the cost of production, manufacturing or processing. Means this method is applicable when you are involved in manufacturing. Or the cost of provision of services. Means or this method is applicable when you are involved in providing services to a related party. So if you are involved in trading, that you are buying and selling, you cannot use this method. And if you are only supplying to your AIs, to your related parties, you may not be able to apply the first method, that is Rule 4, that is the value of determination by method of comparison. We may not be able to apply that method as we are only selling to a related party. We cannot apply computed value method because it talks about cost of production, manufacturing or processing. We are not involved in cost of production or manufacturing and processing. So what to do? We'll move on to the next method. But what it says, the second point it covers, this cost plus method wala, it covers charges, if any, for design or brand. So if you are paying any royalty or if you are paying any design and drawing charges, so that should also form part of your cost. So we have seen your cost of production plus your design and drawing charge plus the royalty, brand royalty, whatever you are paying, that will get included in the cost. Third item that it includes is an amount towards profit and general expenses equal to that usually reflected in supply of goods. So not only your direct expenditure but also other operating expenditure or overheads we need to include. And interestingly, it also talks about profit, which tells me or which suggests that now you may not be able to provide cost to cost services to your related party. So you need to charge a certain markup, which are charged by other suppliers. So it says towards the end, services being valued which are made by other suppliers. So we need to find what are the margins or cost incurred by the other suppliers, and the same needs to be loaded on your direct cost and on the royalty or design charge which you are paying, and then we will come to a conclusion that this is the price that I should have charged to my related party. Interestingly, if we see the cup method, that is the Rule 4, it talks about both internal and external comparable. But when I move to Rule 5, which is in line with cost plus method, it talks about other suppliers. So I'm wondering, let's say if I'm supplying both to my AE and non-AEs, related party and unrelated parties, but involved in different kind of product. So I may not be able to apply the cup. I may not be able to apply or compare the prices. But can I use the margins? Because it restricts me and it says the margin that one needs to take is the margin earned by other suppliers. So probably internal CPM or internal comparison may not be possible under Rule 5. So probably now under rule 5 or by doing the internal comparison, we need to move on to rule 4 and then compute the value. Now last method is the residual method. Residual method says where the value of goods or services cannot be determined under the provision of rule 5, the value shall be determined using reasonable means consistent with the principle and general provision of these rules. So if you are not able to apply the price based method and if you are not able to apply the cost based method, then the whole world is open to you. You need to justify yourself following the general principle, and what I understand the general principle means the arm's length principle. And now we can move on to the Income Tax Act, the methods given, and probably you can use resale price method or a profit split method to justify your transaction value or transaction cost. But I think we need certain clarifications from the department. For example, what will happen, let's say if there are 10 prices. So I have entered into transactions with unrelated party and I have 10 comparable prices. So which price I should consider as comparable? Or can I consider any price? Or should I need to take a mean average of all those prices? Or should I go for a range? Another issue could be, it talks about the related party. At what point in time? Related party during the year, related party at the time of transaction, or let's say you are not related party at the time of transaction, nor even at the during the year, but you became related party during the assessment. So when officer is scrutinizing your return, at that time you are a related party. So I think some clarification is required here also. And the current language suggests that by related parties means related party at the time of transaction, and probably once we will have more clarification it will be better. So friends, now we have transfer pricing provision in GST law also. And when it got introduced in the Income Tax Act, as I told you earlier, it actually became a bleeding ground for corporates. We saw a lot of additions. Out of 100 cases, 60% cases were facing the additions. Now the ratio is dripping down. So when the GST will have TPE, what kind of implications it could have is something we need to think. And also the government or the tax authorities needs to be sensitive. Because if I am justifying my price in Income Tax Act, then can I adopt the same price under the GST? Or again I need to revalue the as per the GST law. So I may be at arm's length under the Income Tax Act and I may not be at arm's length under the GST law. So what would happen? Which method would prevail or which act would prevail? So we need to synchronize it. So tax authorities both from GST and from income tax needs to work together. Thank you. I think I hope I am able to clarify or able to give the brief of transfer pricing in GST law. If you have any query, you can write back to me. My name is Gaurav Garg. My email ID is Gaurav GAURAV @jgarg.com, jgarg.com, and my number is 9899994934. So feel free to contact if you have any query. Thank you. See you again. Bye. चल ही नहीं रहा है।